The summary of Taking Charge with Value Investing, brought to you by Click-Through College. Chapter 1, Introduction to Value Investing. Taking Charge with Value Investing commences with an introduction to the concept of value investing, a strategy that revolves around buying securities that appear underpriced by some form of fundamental analysis. The authors provide a historical overview, explaining that value investing gained prominence thanks to legendary investors such as Benjamin Graham and Warren Buffett. The chapter clarifies that value investing isn't merely about purchasing cheap stocks. It's about finding quality companies trading at a discount to their intrinsic value. Chapter 2, The Basics of Value Investing. Chapter 2 offers a deep dive into the fundamentals of value investing. The authors elucidate the concept of intrinsic value, highlighting that a stock's true worth, or its intrinsic value, is independent of its market price. The intrinsic value is often estimated using cash flow analyses and business fundamentals. The chapter introduces the concept of margin of safety, coined by Benjamin Graham, which is the difference between a stock's intrinsic value and its market price. This margin provides a safety cushion to investors, protecting them against market volatility or poor stock performance. Essentially, value investing is about exploiting market inefficiencies where a stock's price deviates from its intrinsic value. Chapter 3, The Value Investing Philosophy. This chapter delves into the philosophical underpinnings of value investing. It emphasizes that value investing is a long-term commitment, requiring patience and thorough analysis. Value investors, it explains, are independent thinkers who resist the urge to follow market trends or get swayed by market sentiment. Instead, they focus on a company's fundamental value and only invest if its stock is trading at a discount to its intrinsic value. This chapter also introduces Mr. Market, a metaphor for the fluctuating and often irrational stock market, used to illustrate how value investors can profit from market inefficiencies. Chapter 4, Understanding Financial Statements. Chapter 4 educates readers on the importance of financial statements in determining a company's financial health. It breaks down the three main financial statements: the balance sheet, the income statement, and the cash flow statement, explaining how each provides a different perspective on a company's finances. The balance sheet reflects a company's assets, liabilities, and equity at a given time. The income statement shows the company's revenues and expenses over a period. The cash flow statement provides insights into the company's cash inflows and outflows. The authors stress that a comprehensive understanding of these statements is key to performing thorough fundamental analysis and correctly assessing a company's intrinsic value. Chapter 5, Financial Ratios and Value Investing. In Chapter 5, the authors discuss the critical role of financial ratios in assessing a company's financial performance and stability. They delve into key ratios like the price-to-earnings (P/E) ratio, price-to-book (P/B) ratio, and the debt-to-equity ratio, elucidating how these ratios help investors gauge a company's profitability, financial health, and valuation. The authors underscore that these ratios should be used in combination, rather than isolation, to provide a holistic view of a company's financial health. These ratios, they explain, offer invaluable tools for identifying undervalued stocks, the cornerstone of value investing. Chapter 6, Beyond Numbers, Qualitative Analysis. Chapter 6 broadens the scope of analysis beyond the quantitative realm and emphasizes the importance of qualitative factors in value investing. The authors assert that while financial ratios and statements provide valuable insights into a company's performance and financial health, they don't tell the whole story. The chapter explores elements like the quality of company management, the competitive landscape, the company's market position, and its business model. The authors explain that a company with a strong, ethical leadership team, a sustainable competitive advantage, and a robust business model often has higher chances of delivering long-term value to its shareholders, irrespective of short-term market fluctuations. Chapter 7, The Art of Stock Picking. Chapter 7 delves into the intricacies of stock picking. The authors illustrate different approaches to selecting stocks, such as the bottom-up and top-down methods. They advise investors to adhere to their investment criteria consistently, emphasizing that patience and discipline are key to success in value investing. They stress that successful stock picking is not about timing the market, but about choosing companies that can yield robust returns over the long term. Chapter 8, Risk management in value investing. Chapter 8 sheds light on the often overlooked but critical aspect of investing, risk management. The authors identify different types of investment risks, including business risk, market risk, interest rate risk, and liquidity risk, among others. They provide strategies to mitigate these risks, such as diversifying one's portfolio across different asset classes, sectors, and geographical regions. They underscore that understanding and managing risk is as crucial as identifying profitable investment opportunities in value investing. Chapter 9. Behavioral Finance and Value Investing. Chapter 9 introduces the concept of behavioral finance, discussing how cognitive biases and emotional factors often lead investors astray. The authors identify common biases, including overconfidence, confirmation bias, and loss aversion, that can adversely impact investment decisions. They emphasize the importance of self-awareness and emotional discipline in successful investing, offering strategies to overcome these biases and make rational investment decisions. This chapter underscores the often overlooked human element of investing. Chapter 10. Value Investing in Different Market Conditions. Chapter 10 probes how value investing principles can be applied in various market conditions. The authors detail strategies for investing in bull markets, rising markets, bear markets, falling markets, and periods of high volatility. They stress that a true value investor doesn't try to predict market directions or changes but remains committed to their investing principles, identifying and investing in companies trading below their intrinsic value. They remind readers that market fluctuations should be seen as opportunities to buy quality stocks at bargain prices or to sell when the prices appreciate considerably, rather than as threats. Chapter 11. Value Investing in International Markets. In Chapter 11, the authors expand the horizons of value investing by discussing its application in international markets. They outline the additional challenges and risks that come with international investing, such as political instability, currency exchange rates, and variations in accounting standards. They also present ways to manage these risks. The authors assert that investing in international markets allows investors to tap into growth opportunities in emerging economies and provides added benefits of diversification. Chapter 12. Value Investing in Bonds and Other Asset Classes. Chapter 12 extends the application of value investing principles beyond stocks, explaining how they can be applied to bonds, real estate, commodities, and other asset classes. The authors explain how to calculate the intrinsic value of these asset types and the importance of investing at a margin of safety. They elucidate that the key tenet of value investing, buying an asset for less than its intrinsic value, is universally applicable. They underline that broadening the investment horizon can help investors find attractive investment opportunities and achieve better diversification. Chapter 13. Modern Value Investing, Incorporating Growth. Chapter 13 introduces the idea of blending traditional value investing principles with elements of growth investing. The authors explain how some modern value investors, including Warren Buffett, have successfully adopted this approach. They argue that while traditional value investing focuses on buying stocks at a discount, considering the growth prospects of a company can lead to more lucrative investment opportunities. They underscore that a company with solid growth prospects trading at a reasonable price can be an excellent investment. The chapter concludes with a discussion on how to identify such growth at a reasonable price (GARP) investment opportunities. Chapter 14. Building a Winning Portfolio. The final chapter guides readers on how to build a winning value investing portfolio. The authors discuss the role of portfolio construction and asset allocation in managing risk and enhancing returns. They provide a step-by-step approach to building a diversified portfolio aligned with one's investment goals and risk tolerance. The chapter concludes by emphasizing that successful investing is a long-term endeavor that requires patience, discipline, continuous learning, and adherence to the value investing principles. Taking Charge with Value Investing is a comprehensive guide that provides readers with the tools and knowledge they need to successfully apply value investing principles. The authors stress the importance of due diligence, patience, and emotional discipline as keys to becoming a successful value investor. They consistently remind readers that the objective is not merely to buy cheap stocks but to buy quality companies at a discount to their intrinsic value. The summary of Taking Charge of Value Investing.